gold for the last 20 years has beaten the S&P on a total return. So for 20 years, it's outperformed the S&P. It's certainly outperforming the sacred cow U.S. 10-year Treasury, the risk-free return, the haven. It's outperformed that dramatically. And again, it's the highest performing asset this year, which is why it's paying attention. But it shouldn't be because it's outperforming just this year. It's been outperforming for years. And yet we've had to apologize as gold bugs for being gloom and doom. And so the lie that's been told to many investors too is that gold is too volatile. And yet now central banks around the world, including the ECB, are trying to get as much as they can.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for June 9th through June 16th, 2025, while supplies last. First this week, we feature 1-ounce silver maples at just $3.09 over spot. Next, backdated 1/10-ounce gold maples at just $39.99 over melt. And right now, for the lowest price we've seen in years, 90% junk silver is just $1 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance, and back with us today is our good friend Matthew Piepenburg from Von Greyers. Matthew, thank you so much for joining us today.
Well, thanks for having me, Elijah. Look forward to it as always.
Fantastic. Well, it's great to have you today. I did want to discuss your latest article about the financial system. And really, one of the main points is that gold is a barometer for the financial system. You say that gold is the financial system's lie detector. And obviously, over the last year and a half or so, we've been seeing gold skyrocket, and really gold continued to show a lot of strength here, nearing 3,500 again here as we speak. So your take on what's happening?
Yeah, again, we've been talking for so many years and been called many things: gold bug, gold shills, perma bears, etc. Again, I've been very openly bullish on markets in 2020, 2024. I'm openly bearish on risk assets in 2025. So I'm not just a perma bear, but I'm very consistent on gold's long-term direction, and I have been for years, certainly since I started working with a mentor like Ian Von Greyers and understanding gold over the last many years. But what prompted me to write this article today, or that came out today, wrote recently, is gold the perfect lie detector, basically, for financial markets, is the reason gold is rising exponentially. Again, I don't know how many all-time highs we've had just in this year alone. It's the highest performing asset across the board in 2025. It's outperformed the S&P for 20 years on a total return basis. U.S. Treasuries are the worst performing asset over the last 5 years. They're down 50%. So this is not a gold bug, gold shill, sell your book, gold apology moment in history. And more importantly, gold has been very, very consistent for decades, frankly, for millennia, but throughout history. But as we hit this inflection point in 2025, there's so many strings we could pull on. But what prompted me to kind of just remind people of the dishonesty and how indestructibly honest, indestructible gold really is was some recent headlines, Elijah, that came out here in Europe, and they were on all the mainstream and yellow journalism. It was just everywhere in Switzerland and Germany and France, etc., that the ECB was making headlines because a group of economists at the ECB finally said the quiet part out loud, as I like to say. They couldn't, it's like a Freudian slip. They said gold could bring down the European system. Now, that's an extremely extravagant phrase. It made headlines: gold bringing down the EU, gold bringing down the economy. It wasn't that gold was doing anything than what it always does, which is hold its value, while paper money gets increasingly debased to monetize, frankly, criminally negligent monetary systems in the EU and the central bank at the ECB. And basically what this ECB economist report is all the physical demand for gold is undermining the European system, because there's been such a massive outflow, as you and I have been talking about over the years, certainly with COMEX, and Andy Schechtman's been following this, and I've been following this, and you understand that these flows from the London to the New York exchanges, way beyond just bricks and de-dollarization, but this need for physical gold and not future contracts on the COMEX or the LBMA exchange. So in other words, countries want gold, but they're in all these derivative levered products, levered 100 to 1, And long story short, Europe doesn't have the gold or the money to meet its contracts, and they have over $1 trillion in derivative exposure to gold. Hence, the headlines, could gold bring down the European system? It's extravagant, but what I'm basically saying is the European system, the central banks, the LBMA banks, the derivatives markets, all these weapons of mass destruction are finally being admitted to and confessed by even the economists at the ECB. And so basically what they're admitting to is it's a lie that paper contracts levered 100 to 1 do not equal an ounce of gold. In other words, they don't have the gold or the money, and they're caught in a major pickle because the counterparty to these European contracts is effectively Wall Street. And again, as things get more and more desperate, again, any string we pull, military issues, geopolitical issues, debt issues, bond issues, risk assets, stock issues, private equity, as things get more crazy, gold becomes more relevant as a conversation piece, as a store of value, and as a sane truth teller. And the truth is, once again, there was another open lie that derivatives and futures contracts and paper gold is not gold. And now there's $1 trillion uh-oh moment in Europe. And when that headline came out in the last week or so, it made me think, Elijah, of the broader theme of dishonesty, for which gold always kind of quietly bides its time and does its honest work. And I was thinking, in the course of my entire lifetime, which I was born in 1970. So, we went off the gold standard in 1971. Nixon promised A, that was just a temporary measure, and B, that your dollar would be worth just as much tomorrow as it is today. So that was the first open lie. Obviously, decoupling from gold has not been temporary. The entirety of my life, we're still decoupled from gold. We don't have a chaperone to our fiat money. And the US dollar has lost 99% of its purchasing power and measured against a milligram of gold. So that was the first obvious lie. Let's just call a duck a duck. And as I was saying that, it's worth noting that even the US Constitution, Article 1, Section 8, our founding fathers said, don't go into the trap of separating your currency from gold and silver, because if you do so, you'll be seduced by that siren of debt. You'll print more money, you'll create more money than you have gold, and you'll go into hyperinflation. That will slowly create social unrest and destroy your country. That was warned 250 years ago by our founding fathers. We violated that in 1913 when Wilson lied again and created the Federal Reserve Act, put the Federal Reserve into law. And I was just thinking of more modern examples when I was once and became a professional on Wall Street. I remember certainly the great financial crisis of 2008, which is effectively a credit crisis from derivatives, unregulated derivatives and mortgage-backed securities levered to the moon. And when I was at Harvard, Larry Summers was the president, and then he became assistant secretary of Treasury. There was a famous thing that never made the headlines. When he was at the Treasury Department, he called up Brooks Lee Bourne, who was the head of the CFTC, which was the commodity office. And he wanted to just lever the heck out of derivatives. And she was saying, this is a very dangerous thing. I don't think you should do that. He publicly humiliated her in Congress and said, trust me, the bankers and the counterparties in these derivative markets know what they're doing and can manage the risk. Well, within 7 or 8 years of him saying that, we had the biggest derivatives explosion, the greatest financial crisis in years. And that was the great financial crisis of 2008. So the Harvard president, the Treasury official, and the great mind of Larry Summers was completely dishonest and wrong. And that was just a recent example. And more recently, of course, we knew in 2021 when we had this inflation spike due to the money printing that Bernanke unleashed and got a Nobel Prize for. Powell said that was transitory. Again, that is not the case. We can bring the CPI down by lying about it, but we still have a major inflationary problem and a major inflationary discussion to have. So we didn't beat inflation. We still, even at the dishonest numbers we're at now, have not reached target inflation. So that was just another kind of a lie. And then again, the lists are long and distinguished. You can get outside of the markets. You could get into politics. We have these phrases like the Patriot Act or the Department of Homeland Security, or more recently, safe and effective, or trust the science, these buzzwords, which again, I don't want to get into a rabbit hole on all those things, but I think many of our listeners would agree that a lot of those buzzwords were just euphemisms to hide really bad facts. But in the case of gold itself, again, gold sits back during this whole string side of dishonesty. I talked to investors from Dallas to Davos. it's amazing what the registered advisory industrial complex or the wealth managers at the big banks, whether it's Pictet or Goldman Sachs or Morgan Stanley or JP Morgan or Bank of America, where you have to have high minimums just to get their advice. They all said, recently until gold made the headlines, is, well, I was always told that gold was too volatile all these years. And yet, again, that's just a lie. Either it's really ignorant or really dishonest. And again, I'm not making these numbers up. Gold for the last 20 years has beaten the S&P on a total return, including dividends. So for 20 years, it's outperformed the S&P. It's certainly outperforming the sacred cow U.S. 10-year Treasury, the risk-free return, the haven. It's outperformed that dramatically. And again, it's the highest performing asset this year, which is why it's getting attention. But it shouldn't be because it's outperforming just this year. It's been outperforming for years. And yet we've had to apologize as gold bugs for being gloom and doom. And so the lie that's been told to many investors, too, is that gold is too volatile. And yet now central banks around the world, including the ECB, are trying to get as much as they can. And my whole point was, when the liars have to tell the truth, and when the liars are actually stacking gold at record levels, that's when you know there really is an uh-oh moment. It's certainly who understand gold. This is nothing new to us. We're not, even as Jeffrey Gundlach could confess, these gold guys aren't maniacs. They're not stackers. They're right. He just said it. So again, it's not about being a gold bug defendant or apologist or shill. These things are confirmed throughout history, certainly the last 2 decades. More importantly, the bond king himself, Jeremy Grantham, in the equities side. You look at Ray Dalio, the biggest hedge fund manager, Bridgewater. These guys are all talking about gold now with conviction. We've been talking about it for decades with conviction. So again, it's not a gold bug apology to tell the truth. And what I guess I meant by that article is, gold has been telling the truth for a long, long time. It's been bailing out broken systems for decades, centuries, and millennia, from ancient Rome to the 90s in Yugoslavia, again to 1879 France, certainly the extreme examples of Weimar Germany. But governments always get over their skis in debt, and they always destroy their currency to monetize that debt. And as Hemingway said, debt creates temporary prosperity, ripping markets, tremendous wealth inequality, but it always ends in the permanent ruin of war and inflation. And what are the major concerns right now? The honest concerns about on anyone's mind is inflation and war. And there was a tweet that came out the other day: the debt keeps rising, the bombs keep falling. So it's not a coincidence that we're in this moment in history. Gold is reaching all-time highs again. Policies, and frankly, the sins of the power-hungry, short-sighted, myopic policymakers who only think one election cycle ahead rather than generations ahead, and have destroyed our currency in a slow frog boil since 1971 in obvious ways. And now all of that is becoming so obvious from signals in the bond market and elsewhere that the whole world is catching on. And what we've been knowing for years is now de rigueur in the media. And I just think that's really rich, that finally the ECB economists are admitting to these fantasies. The other lie I mentioned in this article is modern monetary theory. This idea that you can solve a debt crisis by issuing more debt and then paying for that debt with money literally created out of thin air. This is absurd. And it was, as I said in the article that I've said many times, it's not modern, it's not monetary, and it's not a theory. It's been tried throughout centuries and millennia, and it has always, without exception, failed every time. So why do we act so surprised right now that we have the greatest wealth equality in our history, that our bond markets are unloved, that our yields are rising even as Powell, reduces rates? Our yields are rising because there's less demand for our unloved IOUs, because we're in debt. And the debt is no longer just a catchphrase. And that's what this article was saying. I'm trying to just throw a cold shower on people, regardless of their views on precious metals. Just look at the facts. You can have your own opinions on this, but the facts are very stubborn. It is complex. It does have a lot of history. It can get wonky, the comics markets, yield curves, bond spreads, but it's actually very simple. We're spending infinitely more than we earn, and we're filling that gap with fake money. And again, and I'll close with this point because it's a long answer as always to a short question. I was talking to John Rubino the other day, and he sent out an email, and it was very interesting. When we talk about trillions in debt, and we're looking at 37 trillion in public debt in the U.S., or we're talking about billions in interest rate per month that we have to pay, it's worth just reminding ourselves that trillions become just, well, that's a T instead of a B. Trillions are a lot. I'm not quite sure how to write it, but I think it's a lot. But to keep in mind how unsustainable this debt is, how completely fantastical it is. If you were to say a billion seconds ago, that would put us somewhere in the 1990s. But if you were to say 1 trillion seconds ago, that would put us at 30,000 BC. That's how much different 1 trillion is from 1 billion. So when we're talking trillions in debt, 37 in public debt, when we're talking over 1 trillion a year in interest rate payments on our debt, folks, that number isn't just a number with a T. It isn't just a word. It really comes down to your bottom line as a citizen of this situation, as a citizen of this policy. And of course, it does matter. Trillions matter. And gold certainly is rising because those trillions in debt matter. And
now, you recently were writing an article. It was, I believe, about how, there are, as you mentioned, a lot of big money moving into gold. I mean, the central banks are buying a lot of gold right now. But when it comes to the little guy, you say that it's both the whales and the minnows right now seem to be actually moving into the market. Now, if we look at that, and we also look at what is happening in silver right now, where we've seen this huge increase in silver, that seems to be another sign that maybe the common man is just starting to really realize what's going on.
Well, I hope so. I mean, I am always happy to talk to people over the years who can't make the minimums at Von Greyer's because we're a very high-end, high-net-worth client base. It just is how we operate out of Switzerland. That doesn't mean that Egon, myself, and my partners aren't very concerned about everyone else. We talk 99% of the time to people who won't be our clients so that they can, as Egon says, get a milligram here and there, possibly an ounce over the years. I've bumped into a young man who came to visit me in Zurich, who's in his 30s, who works for himself, never went to college, and has been slowly stacking gold. And I'm encouraged to see even ETF inflows into gold now as it's making headlines. I hope people understand that ETF gold is not the same as physical gold. We've talked about that and written about that, but at least it's a sign that there's a move into gold. Many of that demand may come from people just chasing price, like whether it's gold or Nvidia or Bitcoin, they're agnostic. They're just seeing it up 25, 26%. Let's get in. And they're always coming in late on just the price momentum. As we've always said, gold is not a momentum trade. It is a new form of money. It is real money, and it is a long-term investment, and it is there to ensure against the dying purchasing power of your fiat dollar. Nevertheless, it is encouraging to see flows into gold ETFs, but we've always said physical gold is the only way to go. It is interesting that the common man, if he can, and I respect how difficult it is to get an ounce of gold if you're worried about rent, mortgages, car payments, insurance, etc., in a very recessionary backdrop, which is only going to get worse rather than better. Of course, it's hard. But as Egon and I've tried to say, get as much as you can, as realistically as you can, bit by bit, time by time. We've been saying this for years. Now with the price, as you said, near 3,500, there's a race to really do that. You look at Harvard, again, I mentioned that because of Larry Summers. Harvard's endowment's over 50 billion, but they've had to issue bonds recently because they don't have liquidity, because most of their money is tied up into these credit pools, private credit pools, which are, again, Gunlach, who's the bond king, says those are the weapons of mass destruction. I just wrote an article about private equity, which is the belle of the ball, the prettiest girl to dance for many institutions and family offices. Private equity is turning as well because they're not mark to market. They're whatever the accountant at the private equity or private credit fund says they are. When there's volatility in the markets, those valuations tank, and the liquidity is not there as we head into the end of a credit cycle. So again, the smartest guys in the room too, we're chasing the trends, chasing the CIOs of those family offices or those endowment funds, which are just alumni from former banks who are just thinking the way they've been trained and thinking, frankly, in I would call a sustained level of mediocrity. Honestly, it's consensus think, it's safe. It keeps you hired at Harvard or at Goldman to be bullish and to sell diversification models that always work in a bull market when things are going well. And when things start to fall apart, then they come racing in trying to figure out a non-dollar asset, hard assets, including gold, including silver. But even the smartest guys in them are late to the party. And, family office is running around to unload their private credit investments at a discount because they misallocated. Because they misunderstood wealth management, risk management in the form of that pet rock analog old gold asset that no one wants to talk about, but has been quietly telling the truth for centuries and frankly for decades, just in recent memory. I find that staggering. And I find it really funny and comical when people say you're just selling your book when gold has just been quietly outperforming everything else. It's not to say I told you so. It's not to be smug. It's just to tell the truth as we see it and as the facts show them and as the numbers tell us. and to get more people not to just become a Von Greyer's clients. It's to get people to understand the risks they're facing. That gold for us, and certainly for Egon Von Greyer's, who did buy gold and lots of it at $300 many years ago, who has made a very modest fortune, who never brags about it, but has never wavered on the price of gold or the direction of gold, never once apologized for gold. He has high conviction, but he never bought gold just for the price appreciation. Of course, he's happy to see it go from 300 to 3,400, but that was never his goal. His goal was, I need to protect my Swiss franc, my euro, my dollar from itself. I'm going to save in gold and spend in fiat. That's exactly what our clients do. That's exactly what the central banks are now figuring out, late to the party. And that's exactly what the de-dollarization thing with the BRICS is all about. We no longer want to save in U.S. treasuries, U.S. dollars, or paper money. We need a real hard asset that holds its value, that is a store of value, that even the BIS has recognized as a tier one asset, the only other tier one asset besides the laughable 10-year. So these are not gold bug defenses. This is the flow of smart money late to the game. It's the flow of history at the end of a credit cycle. And it's the obvious choice. It's not even, as the ECB economists kind of hinted, gold isn't even an allocation. It's not even a speculation asset. It's not even a hedge. It is a part of the new system. It is a part of the new world reserve currency. It's because it's not the world reserve, it's not going to replace the dollar, but it is the new world reserve asset. It is a strategic reserve asset. It holds its value better than any sovereign bond, whether it's from Germany, China, Brazil, the BRICS, or including the United States. Again, not fable, but fact. The evidence is all around us. And I just wrote this article to remind people of these simple things. Get past politics, get past partisan thinking, get past bull or bear on the S&P, get past strong dollar, weak dollar, milkshake or no milkshake, get past Bitcoin versus gold, because it is the evident truth all around us, whether you're looking at bonds, currencies, central banks, the BIS or the IMF, they all, or the BRICS or the oil trade, everything is about gold at the center of the narrative and about inflation being inevitable, even if we have deflationary periods. It's just trying to shake you by the shoulders and have you look at this. Doesn't mean become a devotee of Von Greyer's gold or Matthew Piepenburg or Grant Williams or Ronnie Sturfula or anyone else or Andy Scheck or anyone else who understands sound money, or yourself. Do your own homework. Look at the facts. You can have different opinions. Even Gunlach, who says, look, if you guys are into Bitcoin, and you like the leverage, you like the return, just buy gold and lever it then if you want. It's going to be more stable. So again, it's not even about these debates anymore. They're getting tiresome. They're important. We could keep having them. And I'm not even saying that gold goes in a straight line. It's just obviously rising because paper money is falling. And paper money is falling because, as history confirms, the debt is too astronomical in these trillions, these unfathomable numbers. And anyway, another long-winded answer, but I just can't understate it or overstate it, enough, that gold is far more than a hedge or an asset class to speculate in. It is literally becoming a new center to the system that's crumbling all around us in any string you pull on, whether we're looking at geopolitics, bond markets, stock markets, tariff wars. Everything comes back to the fact that these countries are broke and desperate, and they're looking for some way to fix things, which is a little too late, I think.
We'll put a link in the description of this video to the two articles we mentioned today. If our viewers are interested in learning more about your writings and all of that, they can find the link there. vongreyers.gold is the website. Do you have any last thoughts for our viewers here?
Again, just remember that we're not perma bulls or perma bears in any asset class. Certainly, again, I've said many times, I've been risk on and risk off in speculation assets and risk assets over the years, been very public about it. My view on gold is be careful not to just take my word for it. Do your own homework, have an informed opinion. Our website is full of articles that go back many, many years. I think you'll find we've been pretty consistent in our message. But become informed on your own. Look at the facts, look at the numbers, be curious, be cynical if you need to be. I think it's very important. But again, it's very, very important to look at other ideas. But again, start with the facts. They're very stubborn. Whatever you want to do with those facts is totally up to you. But I really welcome you and challenge you to find a better asset that doesn't have a standard deviation, the triple digits, that holds its value better than gold. And that really is something that you have to understand is an investment for more than one quarter, one fiscal year, or one trading session. It is a legacy investment that will hold its value better than any fiat system. And the BIS, the World Bank, Frankly, even the Bitcoin strategic reserve, if you look under the hood, it's all based on understanding that gold really is a better store of value when you really look into these things. And so I just welcome people to keep an open mind, be curious, but start with the facts, get away from emotions, get away from politics, get away from, frankly, the consensus think of your financial advisors, and do your own homework, because many of these professionals and many of these experts have been wrong for decades.
Fantastic. Well, Matthew, really appreciate your time today, and thank you for hanging in there. Our viewers hopefully didn't notice, but there are a lot of technical issues before we started, so really appreciate your time and your patience.
My pleasure, Elijah. Take care.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for June 9th through June 16th, 2025, while supplies last. First this week, we feature 1-ounce silver maples at just $3.09 over spot. Next, backdated 1/10-ounce gold maples at just $39.99 over melt. And right now, for the lowest price we've seen in years, 90% junk silver is just $1 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.